Welcome to eLagaan Whiteboard Friday, where we look at complex legal and compliance issues in a simple to do way. This series is brought to you by eLagaan, your partner and provider of end-to-end business services.
Hi, welcome to eLagaan Whiteboard Fridays, where we look at various legal and taxes related concepts in a user-friendly manner for the benefit of business owners and founders. I am Naveen from eLagaan. So today we will look at value added tax or VAT. VAT has actually two components. One is called VAT and one is called CST. So VAT is generally at the local or state level. So whichever state you are dealing business with, the tax that goes to the state government is called VAT. And CST is whenever you are transacting within the between two states. So interstate is CST and intra-state is VAT. So this CST goes to the central government and VAT goes to the state government quota. Now, what is VAT and CST? VAT and CST is basically a tax whenever you are selling any products or goods to the end user or even dealer or even there is any change. So whenever there is a value added and across the distribution chain, this taxes gets levied. What will get levied depends on the billing address. Suppose you are billing from Bangalore and selling it to someone in Mumbai, then CST will come, and if it is say within Bangalore to say another place in Karnataka or within Bangalore, then VAT will come into picture. Why VAT and CST? Because to keep the revenues of the government going, as you have service tax, tax on production of goods, which is called excise. So you have tax on sales of various products and goods, which is called VAT and CST. When there is no fixed limit, certainly the state governments and the government allows some small traders to get exemptions from VAT, but the quota varies from state to state because the state government has an important role to play in this. So few places it varies. Again, there is a little bit difference here. When you say exemption, so generally the state government specifies if your total turnover is expected to be under certain lakhs, then you need not register for VAT. But if you are expected to be more, then you should be registered right from day one. So they don't say that you cross that limit and then you register for VAT. So that's a small bit of difference on the one side. Exports are currently exempted from VAT. So if you are exporting any goods, you can take the exemption. So this is more to boost the exports from India on the goods and product services. You can also claim a set off of taxes. So you can look at, we have given a formula called output minus input. So we'll take this into a little more detailed look. So VAT to VAT. So whatever VAT you collect from your customer and whatever VAT you have already paid to your say wholesaler or dealer or manufacturer, whomever, depending on wherever you are in the chain. So that is called input, and whatever you collect from the customer is called output. So output minus input only needs to be paid to the government. Now there is a small difference here again. So VAT to VAT can be offsetted. So suppose if you have bought it from Bangalore and you are selling it within Bangalore, then you can take an output minus input because both the places you are paying a VAT. But if you are buying it in Bangalore and selling it in Mumbai, then you are while buying you had taken you had paid VAT, but while selling you are charged CST. So that cannot be set off. So only CST minus CST. If you are buying anything say from Delhi, you are buying. So from those amount you can set off the CST. So CST to CST set off is allowed. VAT to VAT set off is allowed. So the balance of whatever comes, you have to pay to the government. Payments are mostly monthly every time. So if you don't pay the taxes within time, again the due date varies from state government to state government, but typically it is about 10th of every month to 20th of every month. And then returns has to be filed monthly or quarterly. So this when to file monthly or quarterly again depends on state government. They have various limitations or slabs specified. If your total turnover is more than say 20 lakhs, you have to file it on a monthly basis. If you are under 20 lakhs, you can file it on quarterly basis. Or if you are a private limited company or a proprietorship company, so these frequencies change. So to get more details on when the payments are due, how to calculate the set-off, what is the applicability, we recommend you talk to a tax expert or a chartered accountant, or maybe you can talk to us at eLagaan. You can contact us at support@elagaan.com, or we have a very fantastic FAQs which can also be checked at elagaan.com/kb. So just a quick recap, what is VAT? VAT is a tax on sale of products and goods. You have two components, VAT plus CST. So CST is applicable whenever you are selling it interstate, and VAT is applicable whenever you are selling or buying intra-state. Why? Because the government needs revenue, so it's an indirect tax again. It's not a direct tax. So when varies from state to state, it could vary from 5 lakhs to 10 lakhs depending on which state you are operating on. You should check with your tax expert. Exports are currently exempted. There are many more goods like fruits, vegetables, and all these are also exempted from VAT. So again, you should check the applicability of VAT and CST on your products and goods. Set-off is available, output minus input, but set-off is available between VAT to VAT and CST to CST. You cannot take a set-off between VAT and CST or CST and VAT. Payments of the taxes are on a monthly basis, and returns are filed every monthly or quarterly depending on what is your overall turnover. If it is more than 15-20 lakhs, generally it is on a monthly basis. Under that, you can qualify for quarterly returns. That's it on VAT. Thank you for attending eLagaan Whiteboard Friday. Thank you.